Hello, everyone. Hello, everyone. George Padula here, Chief Investment Officer of Modera Wealth Management. Want to thank you for joining us for our third quarter investment commentary. I'm joined by my colleague, Sarah DerGarabedian, Director of Investment Strategy and Research here at Modera. We've got a full agenda here that we're going to talk to you about. We're going to be talking about what happened in the markets, current investment landscape, our perspectives on market highs. We've received a lot of questions over the last few weeks as people have signed up, and I think we're going to be able to address a lot of them. A couple of housekeeping items. We are recording this, so if you have not had a chance or won't be able to listen to the whole thing, we will record it. We will send you out the recording along with the slides. If you do have questions, please throw them in the Q&A. We'll try to get to them, and if we do not get to them, we will certainly follow up with you afterwards. I do want to just make a quick announcement for our team. As Chief Investment Officer, I'm supported by a really high quality team that we have here. Sarah heads up our research and strategy group. Jesse Goodwin, Director of Portfolio Management, a lot of our trading and rebalancing, and the collaboration between our research team and the portfolio team happens every single day. Our investment committee oversees the firm approach and philosophy and strategy for you. And we want you to have a really high quality, sophisticated investment experience. We want to provide you with our best work, our best research, our best perspectives, and reporting, because really it dovetails in with your whole financial plan and the comprehensive approach that we take for our clients. So let me start with that. First of all, Sarah, welcome. What do we have going on here in the third quarter? What's happened? Busy summer.
Yes. Hey, everyone. Just want to take a quick look back at the recent third quarter, which ended September 30th. So we continue to see good results in the markets across the board, all green arrows, all pointing up. We had the U.S. stock market up 18%, up 8%. Developed and emerging international stocks, also another strong quarter for them. Real estate, the bond market, everything in the green. So it's good to see. We had a couple of things happening in that quarter. We did have the Fed cutting rates for the first time back in September. Of course, they did it again yesterday, and we'll talk about that a little bit later. But we don't have the third quarter GDP readings yet. They're expecting it to be over 3%. The second quarter real GDP growth was revised upward to 3.8% annualized, and that was driven by strong consumer spending and business investments. So a lot of positive drivers for the stock market. And if you want to, we can go ahead to the next slide and look a little bit closer at some of these indices. We break it down here for large cap US, we have small cap, we have the international markets, and a couple of our fixed income. And you can see the third quarter, but also the year to date, super strong, especially for that international equities. Look at that, emerging markets, 28% year to date. It's pretty impressive. And even going out long term, wouldn't you say, George?
It is. We may have it in one of the further slides, but I think the relative performance of international is the best it's been in close to 20 years, if I think. And if you kind of look at that 5-year and the 3-year, if you kind of think where we were 5 years ago, just coming out of the COVID pandemic, opening the economy up back. We hadn't even really started we didn't have vaccines yet. We hadn't had the presidential election in 2020. So it's really remarkable to see how strong all of the returns have been over the last 3, 5, and 10 years.
Agreed. We did see, a little bit of underperformance on the munis side for bonds. My understanding is that they had record-setting new issuance, but that's kind of drawn more demand, which is starting to offset that oversupply. So we should see that kind of evening out.
Yeah, but it really shows the power of diversification, which is really one of the core tenets of our strategy. Diversification, a global approach. And when you even talk about munis, remember that municipal bonds have a place in portfolios for that tax-free income. So people are worried about taxes, certainly up here in the Northeast and Massachusetts. Tax rates are higher, and having municipal bond income is very strong. I mean, if we think about a year ago, where U.S. equities were so strong in 2024. 2023, no one was really talking about valuation and what the impact of valuation is like. No one was really talking about what it means to be globally diversified. And I think if people were really looking at it and getting questions about why own international. And I think you look at this year, you look at over the last 5 and 10 years, really strong reasons why you want to own a broad mix of asset classes in portfolios. So.
Absolutely. And even the small cap up here, the Russell 2000, over the 10 years, a 9.8% return is
Yeah.
really pretty fantastic. And I know that, large cap has done significantly well. But that's not not to say that small and international have done poorly by any means. It's just that large cap has pulled ahead so tremendously.
Yeah. Well, let's look at the next slide because I think, as you talk, we took the quarterly returns, and anytime you go shorter term in returns, it's a flip of the coin generally, right? So daily returns, flip of the coin. The longer you go out, monthly, quarterly, you all of a sudden start to get that shift to where you're getting more positive returns over time. So what are we looking at here, Sarah?
This is great. So the arrow is pointing to where that third quarter of 2025 ends in this spans back to 1988, and they've just ranked them lowest to highest of all the quarterly returns. Yeah, you can see on the left, we did have one negative quarter in the first bit of 2025, but all the others have landed to the right in the positive territory. And look how fantastic the second quarter was. It was almost up 11%. It's
Yeah,
looking
so we
pretty
go
good.
back all the way in, quarterly returns since 1988, and off to the right, positive returns, off to the left, we'll have negative returns. And we did have a negative return in the first quarter. People were worried about tariffs. People were worried about growth. People were worried about taxes. We had that negative return in one asset class. If we overlaid this with international, you'd see a little bit different picture. But then you stick with the strategy, you start to rebalance, and you can see second quarter of 2025 up almost 11%, third quarter up 8%, and then the subsequent quarters in 2024. Again, thinking through what's the long-term strategy. Headlines are always going to be there. Short-term fluctuations are going to happen. Having that long-term strategy is just so important.
And this is such a good visual of, and we'll talk about this a little bit later on, but about how often the market is positive.
Mhm.
And it looks like you could say, if you looked at this, about 3/4 of the time you have
You're right.
positive
Yeah.
returns.
Right. Yeah. So we're kind of looking in the rear view mirror here. Where are we looking at right now? So maybe if we could go to the next section here, the current economic and investment landscape. Few things that we're focusing in on, and a few things that we are seeing in the headlines. One of them is in unemployment and jobs. Another is inflation. Another is interest rates. So we're looking here at a jobs report chart going back to the 1960s, unemployment and underemployment. And what we're looking at here is a situation where employment is the unemployment rate is very low. We see spikes, but with the question that is happening is, are things like technology, are things like AI going to take jobs? Are there worries? We are seeing some cracks. Big companies are starting to hold off on hiring. Some big companies are wondering what's going to happen, with the administration's policies. But we're coming from a position of strength. Sarah, I mean, how do you view that?
Yeah, you can see on this chart the U3 unemployment is total unemployed, and that's the one that most people are familiar with. So
Mhm.
that's that 4.3% number, which, like you said, is historically low. It's below the average of 5.9%.
Mhm.
So we do know that, and this plays into the Fed's decision to start raising rates, that on the employment side of their dual mandate, they are a little bit worried about what's going on. So we do have a few slides here to kind of back up some of those concerns. I know that we have had news that some large companies like Amazon has news that they're laying off some office workers. So this is something to keep an eye on, but the unemployment rate hasn't moved too much because you've also seen some slowdowns in payroll growth, which we'll get to in a little bit. And so, so it's kind of holding things a little bit steady.
Next slide, please. You mentioned payroll gains. Again, surveys, right? So surveys, the way the Labor and Statistics Bureau works is that they are sending surveys out to corporations and saying, are you hiring? How are you hiring? What are the salaries you're using, et cetera? They depend on those surveys and they send out a lot. They get very few back, and then they're statistically using methodologies to extrapolate across the entire country. What's been happening lately is surveys have been slowing down and coming back. And so you're seeing a lot of revisions too, and some of the numbers may or may not be fully, there's a lot of revisions that happen and some of the numbers may not be as robust initially. As they go through some of the revisions, they get tamped down in terms of the spikes or declines. But payroll gains, you mentioned it, Sarah. What are we seeing?
Yeah, so we don't have the September numbers yet from the BLS due to the ongoing shutdown, but we do have some numbers from private sector. ADP has a September report that showed that private sector payrolls fell by about 32,000, and that was the biggest monthly decline since March of 2023. So again, you can see the chart here declining as we go, the latest numbers looking a bit lower on the payroll gain side. So this is part of what is playing into the Fed's decisions when they're looking at what to do with the direction of rates.
Yeah. And if you go to the left part here, you look at the recession happening in 1990 through 92. You see a little bit more to the middle. You see the tech bubble popping in around 2001, 2002. It takes a while for those to come back. Robust jobs growth up until about 2007 through 2011 or 12, as we had the financial crisis. Huge spikes in and around the pandemic. Right. So, we will always see ups and downs in the labor market. Mention revisions. Our next slide actually goes through the revisions and the smoothing out of some of those spikes. So here, Sarah, we look at a much longer period of time, and now this is really looking at the revisions, right?
Right. Yep. And so we see estimated revision here for 2025, the big orange one on the right. And again, like you said, that's looking to be fairly negative, but it's such a lag in the data. I know that, in some things that I've heard, in reporting that I've heard, it is really hard for them to actually get people to respond to their surveys when they call them. So that's some of it. But yeah, it does smooth out when you look at the 5-year moving average of revisions. But I think it is pretty clear that we have some slowing on the labor side.
I just think of all the emails that I get that they shouldn't be getting. So you can imagine when companies get emails and they don't want to respond. So,
Yes.
yeah.
Yes, I feel for them.
Yeah. And then so we have payroll gains, payroll, the numbers and wages. And then the next thing is really our companies hiring, our companies opening, and growing. And that's an important part of our corporate growth, our GDP. Companies are still hiring. Job openings, they're looking for about 7.2 million jobs. Fewer people are quitting their jobs. Again, you see some spikes. We're above average over time. This is called the JOLT survey. Sarah, you want to talk about this a little bit more?
Yeah, so we are seeing slowing again in job creation, and there is some uncertainty whether that's due to a decrease in supply due to some immigration reforms, or is it a decrease in demand? So some of that slowing payroll growth that we saw could indicate that existing jobs aren't paying up to attract more people. So it could just be that, we are seeing
Mhm.
kind of a problem on that
Mhm.
side. So,
Yeah.
and again, some firms are laying off, and some of that they attribute to efficiencies created by AI as well.
Mhm.
But it's still above the long-term averages. You're correct there.
Yeah, AI is having an impact. There's no question. And one of our attendees asked the question, "What about AI? What about jobs? Are jobs being lost to AI?" Hard to tell. I think there's a lot of questions about really the benefits of artificial intelligence. I'm going to put a plug in for our Q3 investment commentary, which I talk about AI and the technology that over time that it allows. It is really just a tremendous growth engine for our economy, but it's also not new. We have a quote in there from an MIT professor talking about AI going all the way back to 1970. Right, so think of that. Think of AI being in the headline now, but really we've been talking about technology and growth in technology since the beginning of the computer age in the 1970s. We think about Apple Computer coming out in 1986. We think about the iPhone. First time the iPhone came in, I think it was 2007. Where will we be in the next X number of years? I don't see that AI is going to replace every job, but I think AI is going to be used as an enhancement, as a tool, as a development with companies. We're starting to use it in our processes. We have a lot of worries and concerns about security behind it, but you also have to worry too and understand how to use it to the best way possible. So, and
Right. I
then
would agree with
yeah,
that. I would say, George, I don't know. Everyone fears that it's going to cause, job loss. I think mostly when things like this happen, it's just a reform of how things are done. And so you
right,
have different kinds of jobs that you wouldn't
yeah,
have thought exist
mhm,
before.
right. And it can impact inflation. So we talked earlier about some of the trends that we're seeing in terms of employment. Inflation has a big impact here. In the right after the pandemic, we were looking at 9% inflation rates. Now we're seeing a lot less. And Sarah, there's so many different ways to measure inflation.
Right. And so this is the other part of the Fed's mandate. And so they've got full employment and stable prices. So this falls on the stable prices side of the mandate. They want to try to strike a good balance between where rates are so that we're not fanning the flames of inflation while we're
Mhm.
not slowing down growth. So we did have a CPI reading recently. So headline CPI is at about 3%. That was the September, or no, the October reading. A little bit higher than September's reading, but it was better than they expected. I think they thought it was going to be a little bit higher than that. In July, it was, I think, at 2.7%,
Mhm.
still below the 50-year average of 3.6%. And so this slide here, that headline number is the block on the left,
Mhm.
showing that currently, when this was printed, it was 2.9. It is now 3%.
Mhm.
And so, it has ticked up just a little bit, and that is something to keep an eye on. But at the moment, it seems like the fears of the tariff effects feeding through to inflation haven't really been fully realized yet.
Mhm. So these numbers are all, again, what's happened in the past, looking through that rearview mirror, right? So we need to think about more importantly and going forward. So what's a good way? I mean, there's many number of ways to measure inflation, but we use a couple of different methods. You want to talk about kind of forecasting inflation? I think it's our next slide here.
Let's see. Yes, this is a good one. I love the thinking about it from the standpoint of the TIPS break-even inflation rate. So this is how the bond market is pricing inflation over the next 5 and 10 years. So you can see right now that the 5 and 10 years is very tight. It's only at about 2.3, 2.4%. So the bond
Mhm.
market is seeing something that's only slightly above the Fed's target of 2%
Mhm.
for much longer term inflation.
Mhm.
So I don't know if you want to kind of explain what that
Sure.
means.
Yeah, so TIPS, Treasury Inflation Protected Securities. So you have you basically what a TIPS Treasury is it has a base interest rate and then it has a kicker essentially. If we see inflation go up over a particular time, it will add an additional amount to the bond interest. It does it in terms of the base rate. But essentially what it's saying is I'm going to buy a 5-year bond or a 10-year bond that is inflation protected, but then to see whether or not I'm actually forecasting inflation, you subtract out the relevant normal treasury bond or bill over a 5-year or 10-year period. So essentially what you're doing is you're looking at the difference between the TIPS rate and the relevant treasury rate. And then you forecast that out. It's a very, very strong forecasting method for saying, what does the bond market? And the bond market is typically ahead of the stock market. So if you're really looking to see kind of what's happening economically, look at the bond market before you do the stock market. Forecast right now from the bond market is somewhere around the 2 to 2.5% range. You can kind of slide towards the middle. You can see what the forecast was immediately around the pandemic time. You go to a little bit more to the left. I'm sorry, you can see around, after the pandemic, you can see the deflationary effect during COVID. You can see some issues in 2016 when markets were getting a little ahead of themselves. But the long-term average is somewhere around 2%. So we're a little bit higher. As Sarah said, we're at about a 3% rate right now. Probably going to stay closer to that 3%. And Fed Chairman Powell mentioned that yesterday. And you see it in some of the news that it's slightly ahead, but certainly nowhere near the fearful inflation that people were wondering about just a few years ago. So.
Yep.
One good thing about inflation, if I'll mention this, and you know, as we go to the next slide, because it talks about interest rates, Social Security just announced you're going to those who are receiving Social Security, it's going to be a 2.8% increase in Social Security for the year ahead. So for those who are getting Social Security, sometimes you want it. You want inflation. So.
Right, and that was one of the reasons they did have, they called a few people in to calculate the headline CPI so that they could give the COLA for the Social Security. So at least we have that number. So now this slide, here we come into what all this meant and why did the Fed do what they did yesterday, which is lower the rates another 0.25% or 25 basis points, however you prefer to think about that. Because they are weighing the two different sides of this equation, the job side and the inflation side. And because they view the inflation side to be a little bit more benign and the job side to be a little bit more worrying, they did vote on a further cut. So now we have a range of 3.75 to 4%, and that was a widely anticipated cut. That was nothing that the market wasn't expecting. And they didn't have all the data they usually have, thanks to our government shutdown, but they proceeded anyway. So yeah, and I think that the other question is people are wondering about, is there going to be another one in December? We had heard that they were thinking about it. Powell now said that it's not a foregone conclusion. He's just not sure. The consumer spending has continued to be strong, and so he's just not sure that that's going to be necessary.
Yeah. So really what we're looking at here is rates coming down over the next 12 to 18 months, maybe another percent. We're not looking at anywhere going back down to zero, are we?
No.
No, we don't want that. We don't want interest rates at zero. That is just unsustainable. It's really bad for the economy. It's necessary in real times of crisis. The Fed did it in 2008, 2009 for a long period of time. They did it during the COVID time, where you have to open up the spigots a little bit to keep the economy moving. But we're not anywhere near that. Some people are calling for a little bit more of a rate cut, or a little quicker rate cut, maybe down to 2%, to again provide more stability to the economy. One of the nice benefits that we're seeing today is that mortgage rates are at their lowest level in more than a year. What we were just talking about it before, Sarah, down about 6.2, somewhere in that range, something like that.
Yeah. 6.1, 6.2.
Yep. Yeah, but down about 0.6% over the last year. So again, if we can have lower mortgage rates, hopefully continue the housing market, strength, hopefully making it better for people to purchase houses, first-time home buyers, hopefully making it better for corporations who are borrowing, better overall, have lower interest rates to a point. So.
Yep, that's right.
Uh, the other question we were getting over the last number of weeks, the government shutdown. What impact is the government shutdown going to have on equities and markets and the economy? We've shown a similar slide like this and around the election. In other words, has the election had an impact, or will it have an impact on markets? And what we're looking at here is the number of administrations, and red or blue, going back to 1980, and those dotted lines are when we've had shutdowns. Well, shutdowns aren't new. We've had shutdowns going all the way back to the Carter administration. We've had shutdowns whether Republicans are in the executive branch or Democrats are. Long run, what you're looking at is the markets tend to overcome those short-term shutdowns, those short-term issues, because the market is a forward-looking mechanism. And Sarah, I'm not sure if you want to add anything to this. I mean, it's hard to forecast shutdowns and the impact.
Yeah.
Right?
Yeah, we were all hoping that we would be able to pull this slide out of the the presentation,
Yeah.
but unfortunately, it is still shut down as of today. And we don't certainly want to downplay the hardship to the employees who have been furloughed during this time,
Mm-hmm.
and to people traveling or experiencing some of the fallout from a government shutdown. But it is true that there may be a hit to GDP temporarily as a result, but it's not something that tends to harm the market in the long run. So as far as your portfolios are concerned, really nothing to worry about from a shutdown perspective.
Mm-hmm.
It's really going to affect the people who are not receiving pay right now. But no, I think that they say the federal government employment only makes up about 1.8% of the workforce, which is why any hits to GDP would be slight.
Yeah. And it's very important too to think about these, where what can we control? We can't control what the length of a shutdown may be. We can't control what goes on in the Fed open market committee meeting. It's been a long time since they've invited either Sarah or me, so I'm not
That's
waiting
right.
on the sideline for that. It's very hard for us to control aggregate technological advances, right? But what can we control? We can control how we think about allocations, how we think about risk in the aggregate. We can control how we think about portfolios and how they impact in the totality one's financial planning. We can control via tax location or asset location taxes. So those are the things that we can control, and we can also control within our own operations here. And I showed at the beginning our team. When markets are volatile, when markets are moving up and down, we want to be able to rebalance. We want to be able to buy into asset classes that are a lower valuation and be selling out of asset classes that are a higher valuation. The other questions we get when we talk about valuation is, wow, the market is at an all-time high. I'm waiting for a correction. I'm waiting for a crash. That's really hard to time. And as you'll see next, I'm not sure it's the right way to think about it. Might be the wrong framework. So Sarah, why don't you start on this slide? Because this is one of the slides that both you and I like, and I'm going to give you first shot at it.
Awesome. Thank you. Yes, this is a great slide because each of these bars shows how many times in that calendar year the S&P 500 hit an all-time high. So you can see that in many years you have multiple all-time highs, and they tend to cluster. So I think a lot of times, what people hear is another all-time high. Well, it's bound to come down soon, right? We have to have a downturn now. I probably shouldn't put my money in at an all-time high. The problem with that is that happen, like we saw in the earlier slide, 3/4 of the time is the S&P 500 has been in a bull market about 75% of the time since 1928. So if you're waiting for a better time, you often aren't going to find it. So trying to wait out those highs, wait for pullbacks, it's definitely a losing game because you're not going to be able to get it right. I think that maybe, did you have the example that, I can't remember who did, but it was in the late 90s. Um, there, when you thought, everyone thought they were at a top and it kept going up, kept going up. So you would have missed so much had you not chosen to go in at that time.
Right. I can't remember the exact year, but Fed Chairman Greenspan had his very famous phrase, irrational exuberance. I think it was 98 or so, and maybe 90, actually it was before then. And yeah, we went through multiple more years of positive returns. I think the key thing, though, is you relate this to that quarterly chart that you had earlier, which kind of goes from worst to best. Yeah, about 75% of the time markets are up. So if you're having that positive momentum in markets over time, you are going to be hitting all-time highs a lot. But again, it gets back to what is the purpose for a portfolio? It's to provide long-term growth and for supporting your financial planning. It's also to make sure that you're not taking more risk than you need to achieve your goals. And diversification and asset allocation and valuation are hugely important. And so this is just the S&P 500. We have a whole world out there, and valuation is a very large concern for us, a very, powerful mechanism for us. We don't want to pay $1.50 for something that's worth $1. So we've been looking a lot at international equities. We do have about 1/3 of our equity allocation to international, our 2/3 US. We own large cap, we own small cap, we own developed markets, we own emerging markets. We want to own the world. So over the last couple of years, we've really looked a lot at valuations. And so from a price earnings perspective, US right now is trading about 23 times earnings, international trading about 14, 15 times earnings, a very wide gap. As we think about the dollar declining in value, providing some backdrop for international investing, if we think about the improvements in the international economies, you're really seeing strong opportunities overseas. And this time last year, I'm not sure people understood that or were willing to recognize that, but we put it out there in our fourth quarter commentary that we still do believe that a global asset allocation is important for the long-term success for our clients. And you can see it this year. International equities up 25, 30%, US equities up great, 15. But there's a huge gap that you would have missed if you said, all I want is just one small sliver of the market.
Right. And another thing that this slide makes me think of is the question that we get about, are we at a top? Is this a bubble? How do we think about that? And yes, it's true. U.S. valuations are high. It's above the 5-year average of about 20, 10-year average of about 18.6. PEs during that dot-com era were as high as 44 times for the S&P. And a lot of that was really, it was all P and no E. So everyone was excited about the internet. They were bidding the prices up on these dot-com stocks, but there really wasn't a proven history of earnings for these companies. So when we look at these PEs from today, they're high, but they're not sky high, and they actually are supported by earnings growth, particularly of some of those companies, again, the Mag 7 and the AI driven hyperscalers that people
Yeah, I think the next thing shows exactly what you're talking about, Sarah. That support, the E for the PE ratio. So
exactly.
We want to own technology companies. We want to own consumer products companies, communications companies as the asset classes within portfolios. But as we think about when we're looking at our allocations, there are multiple factors to think about. Quality is one, profitability is another, dividend growth is a third, valuation is a fourth, right? All these different sizes a fifth, all these different factors build in, but really, as Sarah said, you got to have the denominator there, E, and earnings have been strong, supporting it.
They have. They have. So we know in the second quarter, it was over 80% of the S&P 500 companies that exceeded earnings expectations, which is far above the long run average. And then the third quarter earnings season is underway. It just kicked off a couple of weeks ago, but so far we've had about 30% of these S&P 500 companies reporting, and results again broadly topping expectations. They have resilient profit margins, growing revenues. The beat rates are ahead of historical norms.
Yeah.
So we're seeing a lot of earnings strength, and these are different companies than the ones from the late 90s. It's not really the same thing. I know there are a lot of people are trying to draw like parallels to that situation. It's not exactly the same. There may be a little bit of AI build out ahead of realization, but I don't think we're in any sort of the same situation that we were then.
You're spot on, Sarah, because another question we've been getting is, I want to invest just in the AI companies because they're going to, which AI company should I invest in? I'm not sure that that's the right framework, because artificial intelligence and technology and the efficiency and the usefulness and effectiveness of technology is permeating throughout every company out there. In the early 2000s, if you just added .com after the end of the company, suddenly you're worth 5 times what you were, no matter what. People are, as you said, Sarah, trying to make an equation to AI. I'm not sure that's true, but I also don't know 5, 10, 15 years down the road if the companies today that are the most successful will still be around. And it's very easy for us to go back into the early 2000s and late 90s to look at WorldCom, to look at Digital, to look at Netscape, to look at Ink2Me, look at many companies that are no longer, that they were supposed to be the next big thing or the sustainable thing. Even companies that are still around, IBM, Intel, Cisco, it took a long time to continue. So we want to own the market. We want to own it, but we want to own it at the right price. We want to think about it in the factors that make sense, that are pervasive, that are sustainable, and are really rooted in kind of in an evidence-based approach.
Yeah. Yeah, I agree. I don't have any expertise that would allow me to choose the exact winners of this of this race. I remember when research in motion was a big thing because everyone loved BlackBerry. Does anyone own a BlackBerry today? I don't think so.
I'll have to look at my Palm Palette to see if
Right.
Yeah. Well, you mentioned I don't have the right timing. So what about timing? That's another question we get. It's all kind of tied in together. Market's at the top. I want to time the market. I don't know.
Yeah. Yeah, this slide, this is an interesting slide. It's talking about if you were to miss the best days. And so the thing you have to remember here is that often the best days in the market follow some of the worst days in the market. So what happens is the market takes a dive, people get scared, they pull their money out, and then you see a sharp recovery. You don't know when, and by the time that recovery has happened, you have missed a huge upswing. So what they did here is they took $1,000 over 25 years, and they said, okay, so it would have grown, this is the S&P 500, it would have grown to 5639 if you had remained invested over the full time period. But if you removed and went to cash during those best market days, whether it was 1 or 5 or 10, that is the resulting return you would get after 25 years. And so you can see that it really rapidly erodes the return of your portfolio if you start trying to time the market up and down. Not a good strategy.
But there's a difference, though, with reallocating, rebalancing than trying to time the market.
Right.
Yeah. I mean, I think that's part of it, is being disciplined, having the tools, and there's a human element behind it. There's an art and a science. We use a lot of really high quality, sophisticated software in our rebalancing and our portfolio management, but we have a great team behind us because they have the experience and the knowledge and the communication with our investment teams who know your portfolios, and making sure that we're aligned with the risk and we're aligned with the investment policy statements that we have for each and every one of you. So.
Right. And that goes back to your point, George, of what can you do? So if you're not supposed to tactically move your portfolio in and out of the market, what do you do when it corrects? Because it will go down. Rebalancing, tax loss harvesting, those are two very powerful things that you can do that help you feel a little more in control when, to be honest, you just can't control the vicissitudes of the stock market.
Yeah. Yeah. Uh, One of the things that we're seeing, and there's a lot of things going on, headlines being what they are, there's a lot of concern. There's a lot of concern economically, there's a lot of concern emotionally, human element. And one of the things that happens when people get concerned is they tend to let that fear kind of develop. And one of the trades that or questions we've been getting is maybe I should think about gold. I'm worried about the dollar. I'm worried about the financial system. So gold I hear is a good inflation hedge. And gold is I want to own part of it in my portfolio. What should I do? You have had some really good thoughts and perspectives on whether gold should be part of a portfolio or not. So do you want to start
Yeah.
off with this chart?
Yeah, it's interesting. Gold as a portfolio asset is not my favorite, particularly as an inflation hedge, for a variety of reasons. This chart here is just showing you the returns of gold versus the stock market. Now, obviously, we've seen immense returns in gold over the past year, but this chart goes back to 2007, and you can see the S&P is still handily outperforming gold. And the thing to remember is time frames are important. When you read something about the return of gold and the return of the market, take note of what time period they're quoting, because you can really and set it to be to frame your narrative, if you pick the right time frame. But the truth about gold is it has these lost decades. And if when you look at it in its totality, it might do well for a short period of time. It's very volatile, and then it'll drop back down, whereas the market will continue to march higher. And so going back to your point about rebalancing, if you put it into your portfolio as a diversifier, you need to have enough of it, and you need to be ready to rebalance into those times of weakness. And I think that's something that many people are not willing to do.
Yeah, even in this, you mentioned a lot of timing on this. I mean, just look at kind of the middle here from about 2012 to somewhere around 2020, 21. Gold was negative. I mean, that's a long period of time to wait. It's a very expensive insurance product if you're hoping
Mhm.
for a reduction in volatility. If
That's
we
right.
expand this out a little further, and the next slide brings us all the way back to the 1970s, gold
Oh.
gives you very low return at very high risk. That's
Mhm.
not the equation you want, right? So the
Mhm.
equation is if you want more return, you need to take more risk. Gold is just giving you the opposite. So we go back to 1970 and we got off the gold standard somewhere around the 73, 74. You saw an inflationary spike in 1980, but it took 30 years, more than 30 years for gold to kind of get back to where it might have been. And you just look at the US equities, it's just gold just does not compare as a way to add value and growth to a portfolio. Um, S&P,
No, and it
yeah, go
it
ahead.
doesn't do any. It just doesn't do anything. It doesn't give you anything. There's no uh, dividends. There's no cash flows. It just is worth
Just
what
it.
someone
No
else is going
dividends,
to
no
pay for it.
interest, no earnings,
No.
poor taxation, right? And in
Yep.
fact, when you look at all the years, gold has underperformed in 55% of the years.
Mhm.
Gold has had twice as many down years as stocks. Think of that, right?
Yep.
So it's not
Yep.
only giving you at about one third or one fourth the return, but you have far more risk. So it's a very hard, I mean, I get it. People want to have gold and there are reasons that people want to own some gold. I get it. But typically we're seeing, and what we've found is that people are not owning enough gold to really make a difference, nor are they making the changes that would warrant a proper allocation within a portfolio. And then the
Right.
other reason that people are thinking about gold is as an inflation hedge. And it really doesn't provide that inflation protection that you would want to have. And gold has extreme swings compared to inflation. Again, going back to the 1970s, we looked at the Treasury inflation protected securities. There are far better ways to get inflation protection than
Mhm.
gold as we look at it from an evidence-based research approach.
Right.
Sarah, any other thoughts on this slide?
Yeah, I mean, just thinking about gold as a real asset, real estate is a real asset. And I think real estate's a much better inflation hedge than gold is. And if you look at
Mhm.
this, you can just see the little red dots are the inflation rate, and the big yellow bars are the returns of gold. So they're not correlated,
Yeah.
so it's
Mhm.
they're not correlated. So having it as an inflation hedge is a head scratcher a little bit. I have another statistic showing from 1980 to 2019, gold's annual return 2.8%. Inflation was at 3.1% for that time period. So it
Okay.
certainly
Mhm.
didn't help you then.
Yeah.
And during that time period, the S&P 500 was 11.7. So equities are a better inflation hedge. Real
Yeah.
estate's a better inflation hedge.
Yeah.
Treasury inflation protected securities, better inflation hedge.
And I'll even add in, so you mentioned Treasury inflation protected. I'm going to even mention just a fixed income strategy, right? So if you're 60-40, 70-30, 80-20, everyone has a little different thought process of how much fixed income you should have in your portfolio. We think about fixed income, and we mentioned it before in our commentaries and in other webinars. We look at fixed income in four factors, right? So we look at it in terms of risk reduction, right? We look at it as a stability part of a portfolio. We want income from it. So we want to own corporate bonds. We want to own treasury bonds. We want to own municipal bonds, US international. We want to have a lower duration to help some of that risk adjustment. We want to be broadly diversified. We don't want to just own treasuries. We feel that you can diversify as well within fixed income, just as you can with equities. And we want to maintain a really high credit quality. So we can own high yielding bonds. We can own emerging market bonds. We can own corporate bonds, and we can still maintain a high credit quality. So if we think about, again, that those factors of investment, interest and income and diversification and valuation and risk, it applies to the 30, 40, 20% of your portfolio that doesn't get the headlines that stocks
Right.
do. Right?
Exactly.
So the next slide here, and we're coming up to our time. The next slide is about the dollar. The dollar has come down in valuation relative to other currencies. Interest rates are coming down. The dollar is actually a weakening dollar. We're not seeing a collapse in the dollar. It's coming back to essentially where it was several years ago. We still have the United States dollar as the reserve currency. There are some geopolitical tensions and concerns. Looks like there's going to be a trade relief here with China. People are bringing down the dollar. There's a number of reasons that reserves are bringing down the dollar, but the secret for many multinationals is that they want the weaker dollar. Their overseas profits coming back to the U.S. become much more attractive, and it means too, right, Sarah, for international investing,
Mhm.
really strong.
Absolutely. Yeah, that's, when people say, what do you do about the devaluation of the dollar? You say, well, do you have any international investments? Because they are going to do well in that circumstance. So, yeah, I know there's a lot of talk about the debasement trade and, moving assets to gold and stuff like that. The US dollar still makes up more than half of official foreign currency reserves. So the euro is only second to that at about 20%. So
Mhm.
it just doesn't seem like we're in any danger of losing ground on dollar
Mhm.
supremacy globally.
Yeah, yeah. Well, let's kind of pull it together for a couple of things here, right? So what are our key takeaways? Well, we talked about the economy, talked about valuation. There are some mixed signals in the US economy. There's absolutely no question in that. The labor market is a question mark. The Federal Reserve is talking about that and using that as one of their impetuses and reasons to start to reduce interest rates, that they are seeing some weakening in the labor market. But there are certainly strong GDP numbers. Consumer spending is strong. We are in a stable inflationary environment. So it's a very much a balancing act, a push-pull here. I'll take the left-hand side here, and Sarah can take the right. In terms of equities, are we at an all-time high? We might be, but it doesn't mean that we're going to have an automatic correction. We've shown the data. There are many times when the markets are at a high, and it still means the markets can continue to grow. We've seen some very strong earnings growth out of multiple companies, just not driven by tech. We're seeing strong earnings from banks. We're seeing strong earnings from consumer companies, from industrials, energy companies. There are some easing tensions around the world, and we know that there are some tariff risks, but those seem to be dissipating somewhat. The Federal Reserve's cut of interest rates has certainly been helping and providing some support to the equity markets. We do have some leadership here and some of the technology that's coming out, and certainly the headlines of artificial intelligence. That's going to continue to be a theme as we go forward. Some of those companies are becoming overvalued, and again, we want to own them, but we want to own them in the right way. And again, our focus on quality and profitability and cash flows are making a difference. There's no question, because if we do have a downturn in some of those sectors and some of those companies, having that focus on diversification and quality, dividend growth, et cetera, are going to provide the stability that you want. And we talk about international investing. It's going to be and should be a part of everyone's portfolio. We're not going to abandon it. Again, the lower dollar should provide some strength and stability in that regard as well. And as we think about rebalancing here too. And Sarah, what else are some of the key takeaways that we want clients to remember here?
Well, I think going back to your earlier point, it's important to, like you said, equities get all the spotlight, but the bond market is important as well. And it's important to remain diversified in your fixed income holdings, which is that's the way we like to structure it too. So this year you've seen outperformance by emerging market debt, high yield, tips, mortgage backs, all of those compared to the US aggregate have outperformed. So it's important to have a good mixture in your portfolio, in your bond portfolio, as well as on the equity side.
Mm-hmm.
And then number 6, this slide was again printed a little bit before we had yesterday. So the Fed's got another 25% rate cut yesterday, and that did lead to a little bit of a boost in markets, but they really were expecting it. And again, just goes back to the point that the Fed's trying to balance their dual mandate appropriately. So what we always say, and questions we get, a lot of times people say, well, you sound so optimistic. What about storm clouds on the horizon? What should we be doing about that? I feel optimistic because I believe in the power of human innovation. I think that sure, we will face difficulties, but businesses will find ways, whether it's tariffs or other regulations, to innovate, to grow. And participating in the stock market is one of the most important ways that you can participate in that innovation. And then, just personally, as you said before, George, you have to focus on what you can control. There are a lot of things going on right now that none of us can control. And it is distressing. You hear a lot of headlines. What am I going to do? What do we need to do? So on the portfolio side, we have structured the portfolio to account for all of these moving factors. We have inflation protection built in there. We have that exposure to international. We have all kinds of things built in there. People have to set their own asset allocation based on their own goals and their risk tolerance. So those are conversations that are important to have with your advisor. If you need to make any changes to your own allocation, if you need to bulk up your own cash reserves, think about your spending, that sort of thing. If markets come down, we lean into that with rebalancing and tax loss harvesting. You don't have to worry about that as a client. We do that for you. So those are some things that I would think about.
Yeah, you're exactly right. It's the long term. It's facing forward. It's looking down the road. I mean, one of the things that we, here in New England, Massachusetts, the fall is such a great time for the foliage, right? It's just the colors, the changes in the leaves. I'm a winter guy. I love skiing, but you can't beat the fall foliage, and everyone wants to get the peak foliage. I don't know of anyone who's ever said today is the peak foliage until after it happens, right? So
that's right.
you're there, you make sure that you have it, you're part of it, you can expect it, and you can control the timing in that it's going to happen seasonality, but you don't know the exact day. So trying to shift gears, trying to shift movements simply day to day is really, really hard. But I will put a shout out in our next slide here because we've been doing a lot in terms of education and communication. In fact, our theme over the last couple of years has been about education and communication. There's almost nothing more important for us to do for you than to make sure you understand what we're doing, how we're doing it, why we're doing it. Are we understanding kind of the impacts on portfolios? Are we getting headlines addressed for you? And are we providing you hopefully with some peace of mind? So I'm going to put a shout out to some of the investor briefs. Sarah's been writing some incredible ones lately, and our investment commentary. Last few, this is just a few that are on our website here. We talk about Bitcoins and cryptocurrencies international. Sarah just has one, I think it's on gold and debasement. And so take a look at our website. We've got a lot out there. We also love to get questions from clients. I know you filter them through your advisors. We take some of our ideas as much as we can from what we see and read and ourselves. But I also want to know what's on the minds of you, our valued clients. So keep the questions coming. Let us know how we can help and improve for you. And I want to thank you here at the end of our hour. Thank you for your time. Thank you for listening. Thank you for the trust and confidence you place in us. And however we can help, we are here for you. And as we go through all of our disclosures, you see that. I just want to again thank you very much for attending today and listening. And if we can help you going forward, please let us know. Our next one is going to be in January. Looks like Thursday the 22nd at 1 o'clock. So we will see you then. But in the meantime, enjoy the remainder of the holiday season as we come up here. And thank you very much. Appreciate it.